I had a real estate closing last week, and about 2 days before closing, my client, the buyer, called me and had a lot of questions about the proration of taxes and his insurance that was going to be paid at closing. Now, he asked some really good questions, and I'm sure there's other people out there that have the exact same questions on how that works and everything. So, in this video today, I'm going to walk you through that process. Hey everybody, this is Mark Saunders with Saunders Realty. If this is your first time viewing one of our videos, we're all about Winston-Salem, North Carolina, and residential real estate. If you like those two topics, you're in the right place. Go ahead and click the subscribe button to stay up to date with what we are doing. So here we were 2 days before closing. My client got a copy of their what's called the closing disclosure. It's a breakdown of all the numbers of what goes into closing and how much he needs to bring. And he had a lot of questions about the proration of taxes, how that worked, and also his insurance, how that worked with his escrow account. So obviously, I should have explained it better to him to begin with, but I'm sure we get asked these questions all the time, and I'm sure that there's people out there that wonder how this all works. So number one, let's look at taxes. How do taxes work? In the offer, in the North Carolina offer to purchase, it says that taxes are prorated to the date of closing. So what that means is, let's make it easy. Let's say your taxes on your property are $1,200 a year, $100 a month. So we're going to close on the property July the 1st. So we're now 5 months through the year, and let's just make it easy. We just need to split it in two. So the seller needs to pay their portion, $600 of the taxes, and the buyer will pay $600 of the taxes. Now, most states, the tax bill does not come out until August or September. So in North Carolina, Winston-Salem area, the tax bills don't come out till August or September. So what we do at a real estate closing is the buyer or the seller will go ahead and pay the buyer their portion of the tax bill. So in our example, the seller gives the buyer $600. Then when the tax bill comes out in August or September, the buyer just pays the whole tax bill of $1,200, and it works itself out. So that's how the taxes are prorated at closing. Now, it's different if we're closing later in the year. Say we're closing in December, and the seller has already paid the full year of taxes. Now the buyer is going to give them their portion of the taxes, which is to the date that we close. So if we close December 1st, then that means the buyer actually owes the seller $100 in our example. That's how taxes are prorated. The second thing you look for when you're doing closing is insurance and setting up an escrow account. What is an escrow account? Escrow account is an account that your lender most of the time is going to set up for you. It's just a special savings account. They're going to include these escrow fees into your monthly payment. So let's say your mortgage payment's $1,000. Let's say your insurance is $1,200 a year and your taxes are $1,200 a year. So what they typically will do, your mortgage payment's $1,000, but you will owe $1,200 a month, an additional $100 for the taxes and $100 for your homeowner's insurance. When you make that payment, the lender is going to take that money and set it in what's called an escrow account on your behalf. And the reason they do that is they really don't trust you to pay your taxes and your insurance. They want to make sure that those taxes and insurance is paid to protect their interest in the property. So every month you make a payment, a portion of that is going to go to your insurance, it's going to go to taxes, and then when the bill is due, your lender will actually pay the bill for you out of that special escrow fund. They do that just to make sure that the house has insurance, because if it burns down with no insurance, the bank will be looking at a major loss. And then two, they want to make sure your taxes are paid, because if the county forecloses you for lack of taxes, then it could actually remove the bank's interest as well in the property. That's why they really don't trust you for that. So typically when we're closing during the year, you're going to go ahead and pay a full year of homeowner's insurance. And so that's going to have you set for the first year, and then every month 1 through 12, you're going to pay a little bit extra on your monthly payment. And then whenever the insurance bill comes due next year, the bank already has those funds to be able to pay it. So hopefully that makes that a little clearer. It can be a little confusing depending on what time of the year you close and everything, but that is what happens when you prorate taxes and you escrow your taxes and insurance in your mortgage payment. Let me know what you think. If you have any questions about this, or would you like some other examples of how all this works, leave me a comment below. We'd be happy to help. Thanks.